All right, we're live.
I think we're live. I think we made it. We did it. Round 2. I'm doing a tweet right now. So, Sonu, you talk. I'm going to do a little social media promotion.
Right. I'm busy pouring out a cold one for myself. But, hey, Colin, how are you?
I'm great. How are you guys? I'm still doing coffee.
Oh, there you go. It's early. You're on the West Coast. Where are you?
It's noon. I do on Fridays, I do all my alcohol drinking between 8 and 9 a.m. So I like to get real drunk early in the morning. So if I say anything stupid, you can blame it on that.
No, now we're just playing the coffee. But no, thank you for being on. This is such an honor. We've been meaning to chat with you for a long time. And, before I get into introductions, I'll just say this. I actually pulled up my Kindle on my phone. And one of the first books I have there, this is about a decade ago when I had a Kindle, and I don't use a Kindle anymore. One of the first books I purchased for the Kindle was Pragmatic Capitalism.
Wow.
Right? And that was Colin's first book. Take it from there, Colin.
A real nerd. We've got a true nerd, everybody. Pragmatic Capitalism. That it's funny. So I just came out with my second book, Your Perfect Portfolio. And it's funny going back to Pragmatic Capitalism because that book I was reading through it and I was like, this book is bad. Or this book is boring. It's just it's for people who don't know, it's
actually a very good book. I will say that.
It's part macro econ and part finance and investing, but there's parts of it that are so wonky that it can be a little dry, I think.
I mean, just to give everyone a sense of the wonkiness in that book, I'll just say this one. You even described like the Levi-Kalecki profits equation, which, by the way, is a big framework of how we, manage portfolios, think about macro here at Carson Group between myself, Ryan, and a couple of our other, co-portfolio managers. But it gets to the idea of one person's income being another person's spending. Right?
Yeah. Mm-hmm. Yeah. I mean, I don't know. So much of my framework is sort of, I guess, like getting away from the noise of especially like the financial media, because there's just so much nonsense involved in all of it. And I've spent so much time in my own career fielding questions from clients and people who they read these scary narratives and they're like, is this BS or is there some semblance of truth to this? Or what do I need to really pay attention to? And so I've spent like an egregious amount of time just trying to like drill down into like first principles and understanding things for what they are so that you can kind of distill and digest, concepts like, hey, do we have to worry about the national debt and the government going bankrupt? Or is the debt ceiling a reason for me to sell all of my treasury bills and stuff like that? Where when you put these things into a really sort of like first principles understanding, you can start to compartmentalize how important is some of this scary stuff and how much of it is just pure nonsense.
No, that's good. So quick story, everybody. Quick story. So we've got an hour. We've got time, right? So I got a haircut a little bit ago. Went to a new barber. My kids have gone to this guy, and we're in there talking. And the guy, some other two over, they were talking about how there's this new barbecue place, and they go and have beers. And the guy's like, "You guys should go and have some beers and then come back and cut hair." And the guy's like, "How's that any different than any other day?" And I'm thinking he's like got clippers and stuff, and I'm like, I don't know about this. So we'll see. Now I will say him. Oh. Yeah, well, yeah, exactly. Now I do have a really, really. My desk is uneven, Colin, so I have to pull something out. I've used this for about 3 months now as a perfect stop for the debt. Let me pull it up. Oh, here it is. Here it is. Here's your book. Here's your book. I'm putting your book to use here. I'm teasing.
I was hoping you'd pull out a Flowbee.
Yeah, the perfect portfolio. Wanted to get into this. When this come out, Colin? 3 months ago, 2 months ago? It's new, right?
January 6th. My British publisher thought it would be funny to publish the book on the day of the Capital raid.
Got it. Yeah, easy to remember, I guess. Nonetheless, we're going to get into that, but we are really excited that you are the second guest on Social Hour. Brian Belsky did a great job last month, and Sonu, just all the listeners know, we're planning on doing this the last Friday every month of the entire year. And we're just looking forward to this. So, Sonu, where do we want to start? What do we want to do? There's so much to talk about. How are we doing this?
Just to tell you all how serious this is. Next month I'll be in Disney World when we do this. So I'll maybe do it from Epcot or something. So we want to have fun. But maybe Colin, just introduce yourself. Let's start there.
Yes, I'm the founder of Discipline Funds, and we're an ETF provider and a financial advisory firm. And so I mostly work with individuals and a handful of institutions, and kind of traverse both the portfolio management world and the financial advisory world.
And so you are an advisor. You're a financial advisor.
Yeah, we're an RIA.
Right. Okay. And So how did you, let's going back again, you're talking about that time, 2012, thereabouts. Is that when Pragmatic Capitalism came out, your first book? And I came across your work during all the wars about MMT.
Yeah. Yeah. So it was weird because I actually had an institutional client in Japan during the financial crisis. And so I kind of had, and this guy was he actually happened to be a trader at a bank. I worked with a lot of banks kind of during and after the financial crisis. And he had a sort of an inside look at basically everything the Bank of Japan had been doing, because he worked as a counterparty at Nomura to the Bank of Japan. And it was really cool working with this guy and he was an older guy. He's passed away now, but he had this just incredible understanding of things like quantitative easing and a lot of the things that we were all trying to traverse back during the GFC, as the Fed was kind of unfurling all these big programs. And it was really cool because this guy is explaining things. And I have a little bit of I was an econ major and have a little bit of an accounting background, at least enough to get myself into trouble. And as he's explaining all of this stuff, I'm realizing that the accounting, he has this very, very rigidly first principles understanding of all this stuff. And he's explaining how quantitative easing, it makes interest rates go down and it causes potentially disinflation in a lot of
this is the time everyone is saying, oh, QE lead to hyperinflation.
Yeah, I was like, you're crazy. Like, what are you talking about? That makes no sense. The Fed's going to print all this money and it's going to somehow cause disinflation and interest rates are going to go down. And he was like, no, you got to put the money printing concept in the right context. And so he's explaining all of this, and then he's showing me the balance sheet dynamics of it. And I'm like, holy cow, this checks out. This totally makes sense. And so for 3 or 4 years there following the financial crisis, I felt like Biff in Back to the Future, where I had all the scores for the games. And I was like, I feel like I know exactly what's going to happen in the interest rate market because of the way this is all going to play out. And so it was, and then I'm explaining all of this. And, I wrote my blog was Pragmatic Capitalism. And this is how most people really know me, is I'm writing an anonymous blog back in 2008 and 2009 that an article from Bloomberg gets relinked onto Bloomberg. And within like a month, the website goes from like 0 readers, or like I have 10 brothers and sisters. They're probably the only people who were reading the website at the time. It goes from 10 readers to 2 million in the matter of like 6 weeks. And I was like, holy cow. And that's where it all kind of started. But I was explaining the fundamentals of how quantitative easing works and these really like nuanced dynamics of the monetary system at like a very granular sort of institutional level, that they were so counterintuitive and luckily ended up being, more right than wrong in the long run, that, that's probably why anybody knows who I am.
So 2 things. My middle son, Sebastian, he's a freshman. We watched Back to the Future with him. I'm going to make up maybe 5th grade, so let's say 4 years ago. And for whatever reason, to this day, like literally, like almost daily, when he gets kind of angry or mad, we call him Biff. Directly from that. So we call him Biff. Like, oh, Biff's coming out. Oh, Biff, what are you doing? But so literally, like, just like it's so funny. So with AI, we all have superpowers now.
You just knock him on the head like this. I mean,
brag a little bit here. So he was named like the MVP on his basketball team, and it said like Sebastian Detrick. They made like this image on AI. His Max Preps. Long story short, I took it in. I said change Sebastian with the word Biff, and then I sent it to everybody on our family text. I used the word text compliance. I sent that to my family. We get in trouble sometimes. We use the word text. That was to my family, everybody. Anyway, but I sent it. I fixed it. It said Biff Detrick. So it's a long running joke. But you said something. I guess I forgot. So you were kind of anonymous back in the day. I didn't realize that. How did you kind of have your coming out party when you announced that, hey, I am this guy behind the wall? How'd that go? That's kind of cool. I want to know how that worked.
Well, gosh, I guess I started to realize that, when you've got a website with 2 million readers,
you better use your name.
Realize like, hey, it was crazy because I started at that point. I was making so much money from the advertising. I was actually making more money from the advertising than I probably was from my advisory business at the time. So it was, you start to realize, oh, you've got an audience. So, you can, there's no benefit to being anonymous at that point. And so I mean, I never intended for the blog to be public. Actually, I was writing it. I was writing it anonymously, mainly for my own journal, mainly because like the financial crisis, I think it was so confusing, everything that was going on. And it was so frightening that I would journal just to like get my own thoughts out on paper and try to digest, hey, what the hell is going on in the world? Because everything was so upside down at the time. And so, but then as I, this is the time when, Twitter is kind of becoming more and more popular. And then I'm starting to, network with people and meet people. And like, the way that I the only reason I know you guys is probably through Twitter and just, interacting through the internet. And so you start meeting all these people and you start realizing like, hey, there's no benefit to being anonymous. So I just, slowly, I guess, unveiled the curtain and, and now everybody gets to look at my ugly mug all the time.
Yeah, one of these days I'll reveal who my burner account is. I'm always screwing with Sonu and always gets mad. It's a joke. I do not have a burner account. Everybody compliance. I'm just making jokes. Anyway, all right, Sonu, go ahead.
Yeah, one thing you've always said, it struck me. I think you had this in your first book too. One is we all talk about investing here, right? I mean, we're investing in portfolios, but you've said that we're all savers in a way. We're not investors. Talk about that. Talk about that perspective. I think that's very interesting, and it brings about like key things to keep in mind when you're constructing portfolios as well.
Yeah, it's kind of a nerdy, nuanced perspective, but it was actually funny when I'm writing Pragmatic Capitalism. That book, because it's a finance book and an economics book, I was going through definitions of a lot of different words, and investing is probably the key word in the whole book. Right. And I realized in my study of economics that the word investment in economics has a totally different meaning than it really does in finance, where in the investment or the economics world, investment means to spend for future production. And
like you're building a factory or something.
Yeah, it's like when you're building a factory or you're spending money, you're allocating capital for your firm to grow future production. And it's interesting to think about this in the context of what we call the investment world, because when most of us buy stocks and bonds, we're not doing anything like that. We're taking some of our income, we save some of our income, and then we reallocate some of our savings, our cash savings, into instruments that are serving different goals, whether it's stocks or bonds or, cash equivalents or whatever it might be. But that's very specifically a reallocation of savings. And the reason I kind of am I guess a stickler about the terminology about this is because I think that a lot of the times the concept of investing is thought of as this sort of like sexy get rich quick scheme. And people think like, oh, how can I pick a stock that's going to make me rich right now? Or how can I, you see it a lot in the economy today where it's like the degenerate economy and people gambling more than ever and the Kalshi markets and things like that, where people are treating a lot of this as it's a get rich quick scheme. And I think the emphasis on savings and reallocating your savings is really trying to get people away from that process, that thought process where they're treating their portfolios more like a gambling account, and they should be treating it more literally like their savings account.
Interesting.
No, it is. I'm going to pull a U-turn for a second. So much to dive into. So I want your take on today's action, though, and Colin, feel free and jump in. We had the PPI came in hotter than expected. Markets selling off. So you do great work on inflation, and you said for a while we might have more of an inflation problem than the market thinks. Today, is that the start of this? What do you think, Sonu?
And here's the conundrum with that, because the 10-year yield is now below 4%.
Yes.
I think 2-year yields are at the lowest levels, I don't know, in a very long time. I'll just leave it at that. I don't know exactly when, right? But then I pull up a chart of staples. Staples are up 15% year to date. And part of me wonders is, again, like we're speculators here in some form, right? So I'll speculate. I think it's partly risk off. Right? If staples are doing well. Now, I think there's still reasons to be bullish. We can talk about the global bull market. You and I have done that. But I think staples doing well is the other side of the coin of, yields going down and the 10-year acting as the hedge to equities. I mean, that's my immediate take. But, you see that in small caps as well. Small caps are down over 1.5% as we speak right now. This is Friday, February 27th.
Yeah. So, Colin, I've seen the chart, and you probably have too, all over X. They say that the Mag 7 X Tesla forward the PE multiple is actually cheaper now for the Mag 7 X Tesla than it is for staples. I mean, this is a stampede of unprecedented movement into staples. Is like, okay, there's no AI there. Let's go into Coca-Cola. Not a recommendation on Coca-Cola, but you know what I mean. What do you look at intermarket analysis? What do you think of staples doing?
Valuation as well, like
and valuation. Yeah,
I do. I tend to focus on the broad sort of more I guess like total market valuations. But no, I do. I look at sectors. I mean, I'm much more focused on styles. So, like in our strategies, the valuations of something like, growth versus domestic growth versus something like foreign value, for instance, is something that I tend to focus on more. But no, I mean, it's really, I love the dichotomy in everything is so fascinating to me right now, because there's more divergences in so many different aspects of the market than there's really ever been that I can remember. Not just in terms of like domestic valuations, or even like, you've got the divergence in the Mag 7 versus the rest of the market versus the huge divergence in international versus domestic, huge divergences in even like commodities, the divergence between gold and silver versus the rest of the commodity market, or there's divergences all over the place. And so in a lot of ways, like in this environment, I keep telling people that, hey, there's no way you can go wrong with being overly diversified in this sort of a market, because I think that, especially with the AI narratives, what the AI narrative is doing is it is causing it's exacerbating so many of these divergences in so many ways, because I think people have no idea how this is really going to play out in the long run. And the inflation thing is actually it's an interesting thing to try to digest, because in a sense, the AI trade and the development of AI across the economy, it really messes with components of inflation. Because, for instance, what's going to happen with energy? I mean, it looks like I have a really hard time seeing how energy inflation doesn't just perpetually tick up. It's sticky at like 6% year over year right now inside of the underlying components of CPI.
Unless AI demand goes down, but that doesn't look to be the case, right?
Right. And so what if it doesn't go down? The data centers keep sucking up more and more power. They keep building more and more. But then you've got the flip side of this is, what if the unemployment narrative plays out? You get a collapse in probably services inflation, and you probably just get at least a pretty meaningful reduction in aggregate demand. That's a hugely disinflationary trend. And so there's all these battles that are playing out across all different dynamics of all the markets. And, I think the honest answer to all this is nobody knows where this is really going.
So, the old saying, diversification's always having to say you're sorry. I mean, for like 20 years, you just should have been in US or large cap the last 10 years. And why in the world do I own small cap value or the rest of the globe? And you've written about this, talked about this, diversification versus the worstification. I think that's a word you use. You give an example of that, or what do you mean when you talk about that? You maybe talked about it a little bit a second ago, but let's dive in there a little more.
Yeah, I mean, there's a fine line between being diversified and creating diversification. And what I mean by diversification is,
did you come up with that word, by the way? Diversification. Is that yours? Did you come up with
that? I don't think so.
No? Okay, we'll give whatever. I never heard that. I like it.
I'm not smart enough to coin my own term.
We'll say you did. It's okay.
Yeah. No, but I think this is this is an example where like you create so much diversification in a portfolio where you actually make the portfolio worse. And for me, this typically would probably entail like adding in like an excessive amount of like really expensive hedging and these elaborate sort of, layers and layers of things that are the fanciful sounding, but actually are just probably compounding taxes and fees for the most part. And so that's something it's weird. Although I'm a real nerd about the way that I systematically implement a lot of my processes, I've really, especially as I've gotten older and life has just gotten more complex, my portfolios have gotten simpler and simpler over time, just because from a management perspective, I defer towards simplicity just to make it simpler for me to digest and navigate all of this on my own.
I mean, I love that because, I feel like we, at least aspire to do the same thing. And hopefully we do. But because, on that point about diversification, I always think like you can get really cute with all these different products we have now, hedges, and it's like, oh, I want to reduce risk. So let me use this and that and options and all sorts of things, inverse funds, et cetera, et cetera.
Yeah.
And I'm like, maybe the best hedge is just to figure out asset allocation. You shouldn't be 100% equities. Maybe it should be 60-40 or something. We can talk about how 60-40 and the issues, pros and cons of that, but just get the asset allocation right, and hopefully you're in a good place.
Yeah. Well, there's a flip side to this that, you like one of the strategies I talk about in the new book is the Boglehead 3-fund portfolio. And, so for people who aren't familiar with it, I interviewed Taylor Larimore, who John Bogle crowned the king of the Bogleheads long ago. And Taylor he took 3 funds basically and distilled all of what he believed were Bogle's core principles down into this, like the perfect distillation of all of Bogle's concepts of creating diversification and low cost, creating something super simple that you can just stay loyal to, stay the course with. And so the portfolio is basically a bond aggregate fund, a domestic stock fund, and an international stock fund. Cool. And it's funny, when I wrote the book, I tried to operate as like a third-party analyst, sort of like an objective analyst, where I would sit back and I'd give the pros and the cons of a portfolio. And looking at this one, you can almost say that this is the opposite of diversification, where you've created something so simple that in a lot of ways, it's almost too simple for the vast majority of people, because the portfolio, for instance, in a year like 2022, what does that portfolio do? Well, it's just a bond aggregate and basically a global stock fund. That thing goes down like 15%. And the person who owns that is probably looking at it and saying, like, I kind of wish I had something else. I wish I'd had, and you see a lot of this these days where people now, coming out of 2022, bond alternatives have become, I think, even more popular because of that year, because people looked at that bond component and they said, that thing was supposed to keep me safe in 2022, and it did anything but that. And so, you can kind of get too cute with making things too simple, I think, also. And so there's an in-between probably.
So this is great conversations. I mean, as someone, Sonu and I manage money, you manage money, we create content, you create content. It's tough to do both, but I think you do it really well. And one thing I really like about your book, so again, Your Perfect Portfolio, hold it up here. Definitely check it out. Came out in January earlier this year. The chapters are like 2 and 3. Talk about simple. I'm a simple guy. Your chapters are like 3, 4 pages, 5 pages. I mean, it's like these principles, and they're very quick, and you can read them. I love principle 2. It's right in the beginning, but you said you are your portfolio's worst enemy. Now, I want your take on that and what you kind of mean by that. But I mean, I've done this. I've worked with financial advisors 10 years, clients for like 20. And that is so true. That is so true, because last April, when everybody wants to sell and everybody feels terrible and the market goes up 9 months in a row, or when everybody's excited, the end of 2021, the government gave everybody money, everybody's day trading, everybody's doing this, crypto, that. What happened? You mentioned 2022 and even bonds didn't work. But when your experience, how are, let's say, your average investor truly their own worst enemy when it comes to this stuff?
Yeah. I mean, Ben Graham said this the best. He said the investor's chief problem and even his worst enemy is likely to be himself. I mean, that, and what you're really getting at with that is that, first of all, the financial markets are really complex. Like, I think one of the things that is sort of awesome about being in this industry is that it's always different. Every day is sort of a different thing. It's always evolving. It's always interesting. And
we always joke, what's today's drama? What's today's, what's the end of the world today? And then the Schultz quote about don't worry about the end of the day. It's already tomorrow in Australia. I like that one. Yeah.
Right. Well, I think Morgan Housel always makes this joke that an honest, or maybe it's Jason Zweig, that he says an honest news day in the financial media would be, something like 200 million people went to work today. They all did roughly the same thing. Nothing really happened. It was another boring day. But, what does the financial media do? They say Apple stock was down 10%. And, Citrini Research published a report that says unemployment's going to 10.5%. And it's all this like, really cherry picked over dramatized stuff. And, for your average person is like, they're a doctor. They're going and performing surgery all day or something. They're coming home. They turn on the financial news for 30 minutes and all they hear is, all this doomsday stuff because that's the stuff that gets eyeballs and whatnot. And so, the point is like this, you're just constantly being bombarded. And this is worse than ever in the social media age, because obviously like, everything's in your face all the time. You're constantly being bombarded with just behavioral bias after behavioral bias. And so the financial world is complex enough to navigate just at a basic understanding. And so then being bombarded with all these the financial media and the behavioral biases on top of this stuff, it just compounds the difficulty of staying the course and navigating all of this and not constantly feeling like I need to constantly be changing things and tinkering and trying to take advantage of what's going on. So that's what makes you your own worst enemy, is that you have to find a way to kind of understand all of this stuff so that you sort of, in a way, you insulate yourself from all the behavioral bias. And this is as true for, your average investor as it is for the pros. I mean, I remember early COVID, and I mentioned this in the book, I had my first daughter in March of 2020. And, the stock market crashes like 2 weeks later. My portfolio is down like 30-40%. I've lost tons of money on paper. And I'm looking at this, and I make the joke in the book. This is my favorite joke, by the way. It's a hidden footnote that has not been caught yet. But I make the joke that my mother-in-law lives in France, and she got trapped with us because of the travel ban. And I say that I was crying in the shower every day, not because of the newborn baby or the stock market, but because my mother-in-law was caught or trapped with us. And she hasn't caught that yet because she hasn't read the book yet. So,
well, one more for me, so I'm sure you want to jump in. I mean, the other thing about newspapers and stuff, I love this one. I don't know who said it, but probably many people over the years. It's just amazing that all the news out there, it always fits in 16 pages of a newspaper. It's always it all fits in there. You want to go the Citrini research route?
I actually want to go
do it. I heard that word. I knew somebody perked up on that word.
Yeah. No, actually, yeah, let's go there. Because you've thought a lot about macro principles, right? And macro accounting and things like that. And can we actually have like nominal GDP growth, like let's say 5 to 10%, unemployment rate at 10%, and productivity growth like way above trend? Like something doesn't compute for me, but you take it from there. Like you've thought about this stuff.
No.
There you go. Okay. No. All right. We're done with that.
That's all I have to say about that. No, I think you're right. I think that it doesn't compute. So that's the kind of the paradox in a lot of these narratives is that how do you have a collapse in unemployment and still have aggregate demand that is sufficient? I mean, I guess the scenario where that is potentially viable, I guess, is you could theoretically have a scenario where the government fills the aggregate demand gap.
Sure. Right.
So maybe you could have a lot of scenario where unemployment is really, really high, kind of like, not unlike the early COVID scenario, basically, where unemployment, shoots really high, but then the government just funnels, tons of money out. And you've got a scenario where you end up getting, a big, what ended up being a big GDP boom. And even though unemployment is still relatively high, I'm skeptical of, so I think the thing that makes AI really difficult to digest and understand is the time horizons over which all of this is likely to play out. So I was going back and forth with Adam Butler on Twitter actually earlier today about
Butler, but
a little bit of this where, Adam and I were basically agreeing on the way that this might play out. He said AI will mostly empower edges of the network because the edges are least afflicted with legacy tech complexity and governance frictions. We're currently in the process of building our own. So he's talking about how his own firm is building all of these SaaS systems, and so he thinks that basically the dynamic over which this is going to materialize is going to be almost the opposite of what I concluded. When I read his tweet, I said, "Oh, yeah, I think that this is really disruptive in the short term, but in the long run, it's probably going to all pan out fine. It'll all, people will evolve and digest and, we'll kind of adapt to everything that's going on." And Adam responded and said, I would invert your conclusion. It's positive in the short term and negative in the long term. And so, he had the exact opposite conclusion that I did from what he was talking about. And I think that's what makes the AI debate really, really difficult to digest. I mean, I don't know. I think I've kind of come to the conclusion, or I'm veering more towards the view that AI isn't necessarily this big catastrophic job killer, but that it's a really what I would call like a disruptive decentralizer, meaning that like if I ran a huge law firm, for instance, right now, I would be pretty scared of what is coming down the pike, because the ability for these large language models and AI systems to do a lot of the work that, let's say you've got, 10 partners at a firm and you've got 50 associates, those 50 associates, maybe probably 40 of them become obsolete to some degree, but not because the firm has to fire them now, but because what's going to happen is you're going to have a competitive force where the 3-person law firm who's got, let's say 6 associates, that law firm all of a sudden has tools where they can operate like a firm that has 20 partners and 40 associates. And so they become the smaller businesses become sort of supercharged in ways where, I think that the small businesses and the entrepreneurs of the world all of a sudden have tools that give them the capability to operate like a much, much larger entity than they really are. And this puts massive pricing pressure on the big firms. And that's the really disruptive component of AI. And, I don't know, maybe Adam is right. Maybe that does result in a lot of, maybe these big firms they're firing a lot of people in the short term. But in the long run, what I think this ultimately all does is, I think it's a hugely, hugely disinflationary trend in the long run, even if there is, even if we're building, data centers up the wazoo and energy prices are remaining really sticky. I think if services inflation is going down, that's going to dominate in the long run. And then you've got, just the broader trend that I think that a lot of this is just, it's going to be really good for the way that the economy potentially grows in the long run, because it's going to decentralize a lot of these big firms in the old school way that the economy operated through, primarily big firms being big employers.
Right. And the big getting bigger.
Yeah.
Right? Which has been the dynamic we've seen over the last decade, 2 decades, maybe.
So that's what we've seen since you and I started working together.
I just wrote like 2,000 words of this stuff. It's on the carsongroup.com/research page. Just came out today. So it's been top of mind. I mean, mostly because like a lot of it was in computing for me, and I've been trying to think through it myself. We manage portfolios, obviously. One thing is, off of segging off one of your points is, I wonder if, big firms are not hiring young people anymore, if you actually see a surge in small business formations.
Let me put a pin in that. 1 second. Sorry. Let me put a pin in that. Great questions. Colin, answer in a second. We're at the halfway point. So I'm just going to do like a little intro. Everybody get a drink of water, take a breath. I see we have like almost 2,500 people watching live on X right now. A lot more on YouTube, a lot more on actually probably not as many on LinkedIn, but that's okay. If you're watching on LinkedIn, we still love you all the same. This is fun. It's amazing how fast an hour goes. It really is. I've got my Detrick whiskey here, just sipping on a little Detrick whiskey. It's tasty. Sonu, what are you drinking? What do you have there, buddy?
I have my Goose Island beer. It's not IPA. I'm not a big fan. It's a Matilda. It's like a Belgian style pale ale.
Okay, Colin, are you doing anything for lunch out there, or you being sober for lunchtime right now?
Black coffee. I drink coffee all day. I'm one of those guys. So
that was good. Me an hour ago, but that was noon over here in Chicago.
Well, it's noon here, so you're just
been busy. But yeah, we love doing these live. Sorry, we love doing these live streams. We're going to keep doing them. So thank you to everyone who's joining us. And I did put on X there if you want to reply to one of mine. If you have a question or two, we can maybe do some live questions as well. So definitely go to my X stream and feel free to reply some questions. We'll try to answer them. All right. So Sonu, I maybe set that question up again. I know I jumped.
Yeah, no, I was talking about like if things get, I don't know, disintermediated. That's a big word. Forget that. If large firms are not getting larger anymore, they're not hiring younger people a lot anymore. I wonder if you'll see more small business formations, thinking, oh yeah, we can maybe do the same thing these big guys are doing. And it's not worth the big guy's time anymore, but it's worth it to me because I'm just one guy. And that income matters for me. But I still don't see incomes falling, even in that scenario. Because I think profits still get created and the economy is fine.
I wonder, like, when people see, the Jack Dorsey tweet from yesterday about how they were firing all those people. I wonder how many of those people are peeling off right now. And today, they're talking to each other and they're saying, hey, let's form a competitor firm, or let's form our own firm that's doing something. And so
Or
I don't
maybe
know. I
they
mean,
come to, I don't know, Carson Group and say, you know what, you're using Dorsey's, whatever. Like, I don't want to name any companies. You're using XYZ software. We'll build it for you inside.
Yeah.
For a mid-size or a small business firm.
Yeah. So I don't know. I mean, again, the time horizon over which it takes for that to the small business formation to actually become accretive to the economy and whatnot. That's the messy part in all of this is that, but I don't know. So far, I think, this trend has been around for at least a few years. And so far, I think that what we're seeing is caution rather than like a collapse of any type. So I think that like part of the reason why I think
software stocks.
Well, yeah. I mean, but in aggregate, like the global stock market is, what, 1 or 2% away from all-time highs. I mean, it's not like we're not seeing anything really catastrophic yet. Right. But the thing that I think is interesting inside of especially like the labor reports is that you've definitely started to see a trend where firms are pulling back and they're at least saying, hey, we don't know how this is going to materialize. So we're definitely not loading up on employees right now. Even if demand is strong and business is good, we're not loading the boat, because I think what's happening to a large degree is, especially these big firms, they're looking at the workforce that they have and they're saying, hey, we're actually able to pull more out of the people we've got because we've got better tools now. So let's just put the brakes on hiring. But what's not happening is they're not firing people in like this widespread sort of manner where a lot of the narratives have started to say, and I don't know, maybe that's coming down the pike here, but it's not happening yet.
I feel like over the last 2 years, like if there's one report maybe that gets probably, I should say, more play than it probably should, is that Challenger, Gray, and Christie.
Yeah, I knew you were going to say that.
Because I look at that, then 2 days later, unemployment claims come out. It's like, oh, it's fine. Things are okay. Joel's come out. Layoffs are 1.8 million per month, still lower than it was pre-pandemic. And I was like, oh, layoffs are so low. But the announcements definitely get a lot of play, right?
Yeah. I mean, all these surveys are so flawed in their own way or incomplete in their own ways that it's hard to. And God, one of my favorite podcasts of the last year was the Odd Lots podcast with I can't remember the name of the BLS head, but Joe Weisenthal and Tracy Alloway did this great interview with a former head of the BLS, and he's talking about how the data is just getting worse and worse because the collection process has gotten more difficult, and so I don't know. Yeah. And then obviously, you got, the way that the government is getting more involved in the data in weird ways, and the shutdowns have had weird impacts on the data. And so I don't know what you can believe anymore.
Speaking of data, one thing I do appreciate is you have a macro dashboard with a lot of data, and we love data here. But one thing you have is wages, right? Or taxes. How much taxes are being collected from aggregate income, and which is, very crude, but a helpful measure, I think, in terms of, what is aggregate income looking like? Is that growing? Is that crashing? So far, so good, right?
Yeah, so that's at macro.disciplinefunds.com. And I track a payrolls tracker. So it's just taking FICA withholding basically. And, there's a lot of different ways to measure this, but I basically, the way that I like doing it is you take the inflation adjusted 14-week average basically. And so you get kind of a smoothed average through looking at that perspective. And right now it's showing that wages are basically like FICA withholding is up like 1.6% in real terms, which is, it's actually, it's pretty close to a low reading on a year-over-year basis. So a year ago is actually about 6%. So things are slowing. But again, 1.6% is not, it's nothing to.
And that's inflation adjusted.
But it's not a collapse. It's not a decline. I think it's just consistent with that narrative that people are looking at the economy more cautiously, but not necessarily like it's not, contracting.
Yeah. No, not as many new people are coming into the labor force and getting jobs. And just by that, you will see, new income growth shift lower.
Yep.
So, I already quoted Schultz already. He's the guy that made the Peanuts cartoon. So I'm going to do it one more time with Lucy and the football. Sonu and I were talking about this before we went live.
I know where you're going.
Small caps, because everybody gets all bowled up on small caps for years, it feels like, when they outperform and the football gets pulled away and small caps underperform large. I mean, Colin, feel free and jump in. Probably Sonu, we'll start with you because I know you've got some thoughts here. Well, at least today on Friday, after that inflation data, small caps are getting hit. Yes, they're still outperforming on the year. We are a little bit overweight, large over small, so we'd be fine with large caps taking that baton back here. But Sonu, our models this month, I mean, if you say we're net bullish like we have it, we're net, we're bullish, we're overweight equities. Our models in February with a kind of a messy February. Let's be very clear. It's a messy February. All you said, oh, I'm overweight equities. You probably said, oh, you had a rough month. We don't have the final numbers, but we're looking at a pretty solid month overall. What are we thinking until going forward here on how our models just did, specifically brag a little bit, and then also about small, large?
I think, we're definitely overweight equities. We have been now for about 3 years. We didn't see a recession back in 2023. And it's not because we are loaded up on staples either, I should say.
Right.
Right? We're not loaded up. We do like defensive low vol stocks. We've always had that from a strategic perspective. Maybe, Colin, you could talk about low vol investing as well as a factor, because I know you look at factors and things like that.
Yeah.
But we have, going back to something Colin mentioned, we're very diversified, which also means we have a lot of international stocks. We've had a lot of international stocks for over a year now, probably more than, we manage models over 7 billion, probably more than a lot of other model managers out there, which is not a lot, but still, we probably have more international exposure than a lot of other people. I mean, for good or worse, right? I realize
it's been good lately.
Yeah, it's been good. But I think that's helped a lot, right? Yes, EM, there is a South Korea story. South Korea is up some ridiculous amount, like 50, 60%. I don't even know. Maybe it's 65% year to date, driving EM up. But that's part of that AI story, right? And coming to, memory chips and potential inflationary pressures from the fact that you don't have enough of memory chips to go around right now for data centers and your cars and laptops and iPhones and whatnot. But DM, as Europe's done well too. Everyone talks about Europe being the sclerotic, underappreciated, they can't get anything right. Everything's decision by committee. Yeah. That never works out well. Europe's done well, right? Yeah. And I think Europe acts like a bit of a diversifier too. Developed markets overall, including Japan and Canada and Australia, in addition to Europe. So yeah, that's been working well. And that's what we are holding on to for, going forward. I'm not saying we're not going to change it at some point. We could, but even in our strategic portfolios, we are neutral international versus US, right? We have, like, say 70-30, something like that, maybe a little bit more. But and that's where our strategic portfolio is. Forget our tactical stuff. Our strategic portfolios are positioned that way. But Colin, where are you on in terms of international versus US? And I don't want to say timing gets a bad rap, and with good reason, on our business. But how do you think about? Do you think about from a valuation perspective or momentum?
A little bit of both. So, you say, timing gets a bad rap, but I spend so much of my time talking about how there's no such thing as passive investing, because timing.
I like that. I mean, I should say, we are, like, full disclosure, we are market timers here, right? Like, that's what we do.
And frankly, I think that anyone who thinks they're not timing the market to some degree doesn't understand exactly what they're doing. Because I mean, like, from a really sort of academic perspective, anybody who deviates from one chapter in the book is about the global financial asset portfolio.
That's a market portfolio, right?
It's a total market portfolio, and weirdly, nobody can actually even own this portfolio because all the securities in it aren't even publicly available, because half of them are owned by central banks, or half of them aren't, even accessible because of foreign government regulations and things like that. And so this portfolio literally isn't even investable in a proper sense. And so when Vanguard, like, one of the things I love about, the understanding the market portfolio is when you look at the full cap portfolio versus the free float, which is the full cap is the actual issuance versus the free float is the investable assets that are out there. The weight of something like US versus foreign is completely flip-flopped. So the actual issuance is closer to like 40-60 US versus foreign. This is the equity
40 US, 60% international.
Yeah. But if you look at the actual investable, so if you go out and you buy something like Vanguard Total World, you buy what is investable, because Vanguard, as an indexer, they have to buy what is actually available. They can't just put together a theoretical, full cap portfolio and go out and pretend to be buying it. They have to actually buy the investable full free float portfolio. And so it's interesting, though, that portfolio is like 65-35. So it's almost the inverse of what the actual issuance is, which is really interesting because, Vanguard puts together what is technically a passive index that actually deviates enormously from what has actually been issued. And so, and I say everybody does this. Everybody, nobody owns even the Vanguard Total World portfolio of all the outstanding financial assets. So everyone's making a, even whether it's an explicit or implicit assumption, everybody's deviating, and that's totally fine. I don't think, there's stupid ways to be active and there's smart ways to be active, and there's nothing wrong with being active. But I mean, for me personally, like I work from more of I work with mostly retirees and people who are doing like financial planning, and they want certainty of cash flow. So I build like I'm like a bond ladder dork, and like I'm building these like rigidly time structured portfolios where, like, the way that I like to think of something like factor investing inside of an equity portfolio is I try to actually put a time horizon or like a sequence of returns risk of application to it, where,
so let's say you have the low volatility factor, lower duration versus momentum, longer duration.
Momentum is typically like a long duration equity portfolio, where if you're somebody who's, if you're 25 years old and you've got a Roth IRA that you're funding, man, momentum, AI, load it to the gills, full gas, be super aggressive, lose your password and find it in 40 years. And you'll be like, wow, that was amazing.
I want you to explain duration right now, but let me set it up for you, because I think this is an important concept for, and probably underappreciated. You mentioned, I think it was a Boglehead portfolio, right? Aggregate bonds, international stocks, US stocks, 2022 gets killed. But it's a long duration portfolio, right? Yeah. Aggregate bonds maybe have a duration of 8 years or something. US stocks maybe 15 years. Average 60-40 portfolios maybe about 12-year, 13-year duration, something like that, right? So I like that framework. Whereas most people is like, wait, I have to send my kid to college in 2 years. Mm-hmm. So I, need something of 2-year duration. I have to retire in 10 years. I need, duration matched assets for that liability. So talk about duration, explain that.
My days working with bankers after the financial crisis, where banks set up, really rigidly structured asset liability matched portfolios, where a bank, they can't have only long duration instruments in their asset portfolio because they've got short-term duration or short-term deposit outflows and short-term liabilities that they have mostly. And so they have to
unless you're SVB, and then you don't worry about it.
Right. Yeah. Then you just go out of business, or who cares, all the CEOs, all the executives get rich and everybody else gets hosed. But no, you have to be, it's interesting because after working with banks after the financial crisis, I started applying something very similar to my retail investment accounts, where I sort of realized, hey, retail investors have the same mismatch where, what happens when the stock market goes down a lot? What happens psychologically is you realize I have an asset liability mismatch. I own this very long duration instrument in the stock market. But what I want behaviorally is I want certainty. I need a short-term instrument. And so people, what they're doing when they sell into a bear market is they're buying cash, they're buying certainty of a short duration instrument and selling the uncertainty of the long duration instrument. And so, and that's a function of that asset liability mismatch. And so I try to think about all these things across different time horizons. And the bond market's really interesting, as you mentioned, because the bond market in the aggregate, an aggregate bond fund, is actually a relatively long duration instrument. Right. And so for people who don't know, duration in fixed income and bond markets is basically interest rate sensitivity. So it basically means, like, when Sonu mentions an 8-year duration, it basically means that if interest rates rise or fall 1%, that instrument the principal will change by roughly 8% inside of that instrument. And so when interest rates rise, when they go from 0 to 5 in an instrument with, 8-year duration, if that happens inside of 1 year, that portfolio falls by, 30 to 40%. And so it gets demolished because the interest rate sensitivity is so extreme. It's much longer than people think. And so, I think that the bond aggregate example is so interesting to me, especially because from an asset liability matching perspective, like I kind of hate bond aggregates because bond aggregates are loaded to the gill with a lot of long duration bonds, a lot more than people actually know. I mean, the the 7 to 30 year component of a bond aggregate is, what, like 35 or 40%. It's a lot of long duration. And so bond aggregates are very different than like market cap weighted index funds, because the market cap weighted equity fund, it kills bad instruments inside of it. It does this mechanically. And so the S&P 500 is a killer of bad companies, because the bad companies fall out of the index because they fail to actually qualify over time. And so, you don't ride Enron to 0 in the S&P 500. Maybe you ride it to 20, but by the time it gets to 20, it gets kicked out. And then it gets replaced with, a new company. It gets replaced with Google or whatever. And so it's constantly killing. It's got this internal creative destruction element to it, whereas something like a bond aggregate doesn't. The bond aggregate just eats whatever it's being fed. And even if that's, if you live in Zimbabwe and you were buying a bond aggregate, you were just getting hosed with long duration bonds from the Zimbabwean government the whole time. And the United States government is not Zimbabwe by any means, but it's not that different in the sense that like it funds a lot of its spending through long duration issuance. So when you buy a bond aggregate, you're just eating duration all the time, which is actually, when you think about it from an allocation perspective, it's a really bad way to allocate to an instrument.
Right. You have that mismatch between your liabilities, and here duration is sort of like the time period over which you can expect back the cash flows, right? To replace your principal. And there's a mismatch there.
Yeah. So in the equity market, like I would describe like, low vol or like value these days, international, I would frame that as something that has a lower duration. It has probably a more predictable return than something like if you're looking at growth and AI, man, the sequence risk of something like that, the volatility of it, and you see it, almost every day in the market, in the last year or so, the volatility of that thing's just going to be really high. So, it's weird because like, it doesn't necessarily mean that, it's a bad instrument to own in the long run. It just means that your risk adjusted return might be worse in the short term. And you see this, a year like last year where, the domestic market did what, 17% last year? That's really good. But international did 32, and it did it with similar volatility. So when you look at it on a risk adjusted basis, the numbers are just way different on a risk adjusted basis. So it doesn't mean that, like the stat that I love the most is if you bought the NASDAQ bust at the very, very tippy top back in, what was it, 2001, you've done 8% per year since then. Like that's kind of phenomenal.
Like 25 years, right?
Yeah. But yeah, you went through, 15, 20 years of like, the most extreme behavioral pain.
I think it dropped 82% from the peak until, that was a rough one. So we don't have too much time left here. So this was awesome. Thank you so much for joining us, Colin. Definitely want you to promote yourself here in a second before we sign off. Shout out to Pod Pony. I'll say it correctly. Pod Pony helping us with this podcast, which is great. You mentioned the Dow and the one that came out, and I get it. The Dow usually kicks out the losers, adds winners. On August 31st of 2020, they kicked out Exxon and they added Salesforce. Salesforce down like 40%, Exxon up like 300. So listen, we all make mistakes. That's a famous one for a switch that didn't work. We only have like 5 minutes. Tell us a little bit more. Where can people follow you? Again, the book's awesome. Like maybe another promo on the book and whatever else you want to promote here for a couple minutes.
Yeah, I mean, my new book is Your Perfect Portfolio. You can find it on Amazon if there are still.
I'll do that too, Sonu. Look, hold yours up, Sonu. We'll hold them up. Hold it up and then go ahead, promote yourself. There you go. How's that?
Yeah, I got one too.
That's like there's a screenshot. All 3 books are being held up. That's a screenshot.
You guys are awesome.
That's good.
No, I hate the self-promotional stuff, but I don't know. Do people still go to bookstores? I mean, I don't know if I assume it's maybe in bookstores. But other than that, I write, I'm on Twitter way more than I should be. I'm way too online in general.
You got Ryan Detrick here. Are you kidding?
You're going to get all my ideas.
Ryan is way better at Twitter than I am. So if I was as good at Twitter as Ryan is, I would be on it a lot more too. But I don't have very much interesting stuff to say. So no, but I write a newsletter too at Discipline Alerts on the Discipline Funds website. That's kind of where I do like my weekly musings about usually just debunking something scary that's going on in the markets for the most part.
Yeah, love it. Sonu, 5 minutes. What else we want to do?
You already touched on this, but I'll just hit it one more time. We talk about passive and active, but the fact that you said the S&P 500 event, market cap weighted equity index, it's creative destruction. It's like a long-term momentum index. And for it's not like the momentum factor by itself is, but then there's like 33% turnover over 5 years or something like that. It's a lot of turnover.
Yeah.
For something that is quote unquote passive. But I did want to, you mentioned risk adjusted returns, and I'm, without being too cheeky here and too cute, can you eat risk adjusted returns? And this will get back to some of the, stuff you already talked about, but I want you to hit it one more time, because sometimes, when I talk about risk adjusted returns, a knock I get is you can't eat risk adjusted returns, right?
Yeah.
Talk about
Well, I don't know. I laugh about this because, at the end of the day, what are we all trying to do? We all are trying to eat, right? We're all trying to consume. We're trying to have predictability of consumption in the future. And so the person, and ultimately what we're trying to do with our portfolios is we're trying to generate the highest possible return with the least amount of volatility. And so, again, explicitly or implicitly, we're all trying to generate a high risk adjusted return. And so the person that generates a higher risk adjusted return, they should, in the long run, actually have a much better ability to predictably consume. And so I like to always say that this is all about the holy grail of investment management is sequence risk. It is creating that Bernie Madoff type line, hopefully you're not Bernie Madoffing everybody, but that's what everybody's goal is. So when you first of all, when you see that sort of a line, you should say to yourself, hey, something ain't right here. But that's ultimately what we're all trying to do. We're trying to create that high return with a very, very low, especially low negative volatility. And so, yeah, I think it's kind of an unfair kick at active investing that people say you can't eat risk adjusted returns, because the reality is, if I generate 100% returns with zero volatility and you generate, 20% returns with 20% volatility, well, I can literally eat more than you can. If we both invested the same amount of dollars, I can predictably eat a lot more than you can over that time horizon. So I don't know. I think it's kind of an unfair kick at active.
You're in California, right? Where are you located? You're out west, right?
Yeah, San Diego.
So I don't know. We
don't say we're in California.
You're saying you can eat more than me.
We're in San Diego now.
That's a challenge. You said you can eat more than me. I want to get out there. We have an eating challenge. I know. Yes. I don't know. Speaking of which, I was in Indiana.
I'm getting pretty chubby these days, Ryan. I don't know. I've put on about 20 pounds in the last 6 months. So,
welcome to the
club. Are you still building your house? You were doing a whole bunch of construction at one time, right? With the house. I remember looking at your Twitter posts, and there's a whole bunch of work going on.
No, that was before COVID.
That was before COVID. Okay.
Yeah, right before my we got pregnant. Well, not we. My
before
wife
the kids came. That
But But no, my wife got pregnant right before we got our housing permit approved. And then when it got approved, it was like, I was basically like, oh, can we expedite this? And the builder was like, nah, this is going to take 15 months. And I was like, it's going to take 9 because I'm going to be on your ass every day. Yeah. And I was literally by 3 months in, I was putting on a work belt every day. And I was, helping the guys haul wood. By the end of it, I was doing some of the framing, probably to my own detriment, but.
Oh, that's good.
You can't have AI do that.
Well, wait till the robots come. That's what. So that's the scenario that gets really scary. Is when you see a robot. You see a robot navigating a construction site. I think that's when we all have to pack it in and just say, you know what, I'm going to go walk into the ocean and see you in the next life.
Yeah, that's a down way to end it. Let's end it like this. I was in Indianapolis last night. We lived in Charlotte for 6 years. My boys are huge Hornets fans, so we got them out of school early. They love that. Drove 2 hours to Indianapolis, saw the Hornets just crush the Pacers, which was good. Hornets won 9 in a row on the road, all-time record. And I went to St. Elmo's Steakhouse. If you know, you know that I've eaten steak all over the place. Sonu and I've eaten great. St. Elmo's Steakhouse in Indianapolis, my favorite one. They're known for a super duper shrimp cocktail sauce. So just burn and clean out your nose, and it was amazing, but not as amazing as this. This conversation was awesome, Colin. We are so glad you could take some time and join us on the second edition of the Facts versus Feelings Social Hour. Sonu, next month we have you live from Florida at Disney World, and we have Sam Rowe and Frank Capilleri going to join us. We announced that right now for the first time. It could change, but as of now, they said they'll join us. But Colin, this was awesome. Thank you so much to all the listeners out there. Thanks. I saw we had almost 3,000 people at one point just a little bit ago, so we've had huge numbers on this. We love it. We'll keep doing these. Everybody have a great weekend. Thank you, Colin. Enjoy the rest of your day. Sonu and I are done. You've got more work. I'm off the clock. It is. We're done out here on the East Coast. See everybody next time. Thank you. Bye-bye.
Thank you, guys.